please welcome to the stage our next session's moderator, Peter Schroeder, Head of Marketing at Circle, joined by panelists Ben Milne, CEO of Braille, Daniel Lev, CEO and founder of CoinFlow, Farouk Malik, co-founder and CEO of Rain, and Anna Yuan, founder of Purina.
So we're here to talk about stablecoins. More specifically, we're here to talk about stablecoins on cards. Why it's such a hot topic. I think in the news in the last 3 months, you've seen a myriad of announcements, a lot including some of the panelists on the stage, including Rain, but just to name a few names that have been in this space announcing things recently. Of course, Visa and MasterCard, who are here sort of leading the charge in a lot of ways. Rain, Stripe, Bridge, Ramp, OKX, MoonPay, MetaMask, Avalanche, AirTM, Squads, CopperX, Algorand. I guess you could say a few people are interested in this topic, and a lot of people here are involved in the space. And so I want to pass it off to all of our speakers to introduce themselves, why we're talking about this topic today, and then we'll start to get into it. So Ben, if you want to maybe kick things off.
Yeah, I'm Ben. I'm from Braille. If it touches stablecoins, we probably do it. I'll stop there.
Cool. Daniel?
Cool, Daniel from CoinFlow. We're a global PSP that allows traditional forms of payments, card transfers, banks transfers, and as soon as payments are accepted, we instantly settle stablecoins globally and then go from stablecoins to bank accounts instantly as well in 70 plus countries.
Hi, I'm Farouk Malik. I'm the co-founder and CEO at Rain. Rain is a global payments partner for our clients. We make stablecoin infrastructure accessible and provide utility for stablecoins globally to be able to be spent at merchants worldwide.
Hi everyone, I am the founder of Purina. Purina builds on-chain stablecoin products currently on Solana. We run the largest stable swap and we're building stablecoin investment vaults.
Amazing. And hopefully you had a chance to see the last session because this is really a build on what everyone before us talked about. You had Sam from A16Z who was on the podcast for them last week talking about all of this news. You had Rob and Nick from Dragonfly and Castle Island that worked on an Artemis report that came out today. If you didn't get a chance to see it, that really showed card volumes and how they've been growing month over month in usage and volume, along with a lot of other stablecoin statistics. And so with all that to set the stage, let's just start with why this is such a hot topic, why so many people are entering the space, and why we're having this conversation. And I'd love to start things with you, Farouk, and maybe we can start there.
Look, I mean, ultimately, right, I think, the majority of dollars in the world circulate outside the United States. I think that the last great generation of fintechs that was developed and built over the last decade or so, we're focused on that 20 to 30%, which is domestic in the US. And there's been many multi-billion-dollar companies built in that space. With stablecoins as a mechanism for holding digital dollar balances, we are now being able to open up a global customer base for dollar opportunities and dollar utility. And so I think that cards and traditional payment networks, et cetera, need to become interoperable with all of the people globally that have always had dollars and haven't been able to actually use them, right? Many folks, around the world have grown up with dollars in their parents' mattresses, et cetera. And now you can, spend them wherever you want, powered by the stablecoin infrastructure that we provide.
I love that. It's really the access to dollars that's driving a lot of this talk around stablecoins, but we talk a lot about how do you actually use these dollars and what do you do once you have them. And so, Anna, maybe you can talk a little bit about, stablecoins, once you have them, like cards and spending is one thing, but, why are stablecoins better? Why are people adopting these cards, and what are all the other things that people can do once they have these stablecoins?
So I think for most of the audience here, it sounds like a lot of people come from traditional payment space. We're building purely on DeFi, on-chain. Our user base, what they're doing with stablecoins traditionally has been, frankly, trading. But we're seeing that in the last 6 months, people are not just punting 100x long meme coins. They actually want to save and build their wealth on-chain. So a lot of them are like digitally savvy, emerging market, young, like millennial, Gen Z, they work and get paid sometimes directly in stablecoins because they're a freelancer, and they off-ramp a part of it via cards and via other fintech off-ramps, but they also keep majority of their wealth actually on-chain in stablecoins. And what they want to do is sometimes they deposit into our liquidity pools to earn yield. We're building out like real-world asset exposures for them to, it's their equivalent of a 401k because they don't have 401k. It's their equivalent of a bank account because they don't have a dollar bank account. So there's a lot of things that people are doing with stablecoins, and there's like derivatives, financial instruments that generally speaking only accessible to traditional high net worth or accredited investors here. A lot of that is kind of reimagined on chain in different ways, and it's purely permissionless for anybody to try and use.
Amazing. Daniel, Ben, what have you been seeing? Why is this such a hot topic? Why are we here talking about this?
Yeah, I'll pass it to Ben in a second. I'll try to give you a good alley-oop. But I mean, generally, I think in the U.S., money moves. Like, if I want to send you, for being a good moderator, like $5 to go buy coffee after this, Venmo, Cash App, anything like that, it moves instantly. So users in the U.S. typically think money moves instantly. But if you're a business accepting payments, like we go to that coffee shop and you swipe your card, they're not going to see today's Thursday, right? I'm getting lost in my days. But if today's Thursday, they're not going to see that money till Monday. That's pretty shitty. Everyone's talking about instant money movement. So you have to connect these traditional rails, like credit cards, bank transfers, to then go and move it instantly. And the best way to do that, as soon as you connect that card, is to a stablecoin. So you swipe that card and send those stablecoins to that coffee shop. That's instant. So basically, like the TLDR is that users in most jurisdictions, including the US, peer-to-peer money movement is instant and they expect that. But if you tell a business that, they're going to look at you like the sky's green, because that's just not the case. So that's why this is important, and connecting these traditional forms of payments to stablecoins is where you get that same speed across all of the globe. What are your thoughts, Ben?
I mean, yes, yes. We say this all the time, but one of the confusing things about stablecoins is like, it's not like a financial product that has like a specific demographic that you're selling to. Stablecoins are for everyone, and you can implement them everywhere. And the broader sort of like thing that's impossible to ignore once you see it is that the reason stablecoins, which could be digital deposits, could be CBDCs, these are generally all the same things, just with different types of issuers. But behind them, they're running on protocols. And folks, protocols are now better than relational databases for the job. Faster, cheaper, and safer when implemented. So it means developers are going to build on those instead of MySQL or SQL Server or whatever else or Postgres. And so because of that, suddenly you're having developers choose to build the next wave of financial services products on protocols instead of the old databases, which is fundamentally different because the old databases are controlled by whatever VP you need to fly to go see and like get a meeting with in order to get a contract to maybe get access. On protocols, everybody has access. So you can do not whatever you want, but basically the barriers of entry are dramatically lower. And we're in a moment of time where it's like card issuance, credit card acceptance into stablecoins, one-sided liquidity. Like the stuff that these folks are doing is really hard in traditional finance. It's not that it's not really hard on protocols, it is, but like they've already done it. And the rest of us just get to use it and run with it. Like I pay for parking every day in Des Moines, Iowa with my Rain card. I never explain to anybody like what I'm doing or that I'm using a stablecoin. It just works in everyday life. I know this is getting long-winded, but the last thing I will leave you with is like when you build a traditional like two-sided product, like a P2P product like Venmo, it's a closed system. Protocols are inherently open. So like Metcalfe's law accelerates in ways that's never been possible before with money, at least not with dollars. And we're at the beginning of it, not the end. So I feel like, yeah, we're in a moment. It's the beginning. It's pretty awesome to be here.
Awesome. You said something that people say a lot when they say stablecoins. They say better, faster, cheaper. And, you know, I think, Daniel, to your point, you touched on it not just for the consumers, but for the businesses as well. And, you know, we've all been building in this space. A lot of us for many years. Some people are newer here, and we welcome you. But a lot of the things we still need to catch up on when we talk about traditional payments. Some of those things are moving data along with the money, messaging. We're finally getting to the point with some of these things where stablecoins are catching up. You know, us at Circle, we've introduced Recibio, which is you can send messaging along with transactions, which might seem simple, but when you talk about competing with traditional payments, it's a big deal. And so, Daniel, I know we talked about this. How do you think about catching up on all the things with traditional payments and how they work today, and then making it even better with stablecoins?
Yeah, kind of like what I said, like we don't need to fully reinvent the wheel. Like traditional rails are some of them are pretty awesome. Like MasterCard and Visa have access to millions of merchants, hundreds of thousands of banks, but they obviously have they lag in a lot of areas. So it's connecting traditional rails and stablecoins for when they work. Like stablecoins by themselves don't work for a lot of use cases. Like they just don't work right now because they're not always cheaper. Sometimes it's more expensive to get into a stablecoin, to mint a stablecoin, at some different issuers, to burn a stablecoin, et cetera. So really when it gets better is if there's a use case like speed, sometimes it can be cheaper, sometimes it's interoperating with multiple platforms because it is a protocol that stablecoins are better today. And in the future, there's going to be a lot more ways they are better. It's just find those areas that they're better today. So like remittance spaces is a big one. Obviously crypto exchanges, anything that's native to the crypto world, that's like the V1 of this. And now we're seeing a lot of things in marketplaces, things that are two-sided, where if money is moving, if money is on platform, that coffee shop example, right? If it was just the coffee shop and I swipe my card and it's a mom and pop coffee shop and they're getting the 100% commission of that coffee sale, stablecoin's probably not that much better. If there's like multiple baristas and people are working there that you left a tip and you now need to split that payment across multiple people, stablecoins can be a lot better. You can program how much someone gets. You can instantly split it. At the end of the day, if that mom and pop coffee shop wants to give them more money out of their whole stablecoin balance, that open protocol gets sent them stablecoins. But basically when transactions become more complex, stablecoins really shine.
I love that. Farouk, I'm curious, how do we keep making stablecoin payments better?
Sorry?
How do we keep making stablecoin payments better and catching up to traditional payments?
Look, I mean, ultimately, I think the more exciting thing than catching up with traditional payments is unlocking use cases that cannot exist without stablecoin or digital money, right? Like, I'll give you an example. So, Rain, we do, regular card programs powered by stablecoins. We do stablecoin native programs. We do credit programs. We do sort of transactional programs. And one of the things that we've been able to do, which is really sort of game-changing, is we borrow each settlement dollar at the time of swipe, right? So we can actually programmatically borrow money from our capital partners before we have to send it to the network. Everybody else in the credit card business that's working with a warehouse line, for example, has to front all the capital, then they have to turn around, they have to package all of that, then they have to borrow that money. And with us, we can actually just do that programmatically at no marginal cost, right? And so just the cost of being able to do it on chain for us is hundreds of thousands of dollars a year in cost savings. And that's just for us, which is a relatively small player in the overall payments industry globally, right? And so you can extrapolate from that, just a slight marginal improvement in our ability to operate allows us to offer superior economics to pretty much everybody else in the market, just because we don't have to worry about some of the overhead of having to deal with a fiat warehouse facility, right? And so there's a lot of these things which we're doing, and then even our lenders, they can actually programmatically get paid back when our customers pay their bill. And so it's all automatic. There's actually zero human intervention in this entire process, and it's completely changed the entire game. And it's made it, and it's done in a way where like, we're the only ones really experiencing it, but our customers experiencing and the cost of operations going down, and the efficiency of being able to partner with us, improving their overall income and ability to grow their business. And so I think that's where a lot of people I think maybe here are really interested in how do we eat existing payment rails. But I think that I would challenge everybody to think about what are the things that if you got to design payments from first principles today, what are the things that you would want it to do that you can't do today? And I think that that's really the promise of digital money, and that's the promise of stablecoins, that's the promise of open ledgers, and the promise of smart contracts. And that's where we're excited. We're building all the underlying infrastructure to enable this future set of problems and solutions that you really can't even solve today. And that's the exciting part.
Yeah, I love what you said there. If you think about building payments from first principles, what would you build today? And stablecoins are almost the foundation to actually take action on that thought. And so, Anna, I'm curious, how do you think about that and what more you can do and build with stablecoins?
What's interesting for me is the entire financing that goes around stablecoins. So for Rain, Perenna would be like an example of a provider of loans because we take capital from anonymous LPs on chain, and we can lend to somebody like Rain for their, in lieu of a warehouse financing. But I think what's super interesting is that traditionally there's a lot of friction. It's not very interesting to think, okay, I put some dollars on a blockchain. Like we've done that already with fintech. Yes, it's siloed, but it's already doable. We can go home now. But what's more interesting is like with putting money on the blockchain comes lower cost of capital and more ability for everybody to access these things interchangeably and also in a modular way. So a couple examples I think are interesting with Rain and Coinflow is, like for example, a lot of our users cannot pay for AWS subscription. They're startup founders. It's actually a really, really big pain point in like India, Nigeria to get access to them. So with stablecoins, through like a card provider like Rain or one of Rain's partners, they can now purchase SaaS subscriptions to build their businesses. Other examples that are related to card could be that traditionally you have to have IDs for, I think you guys are Puerto Rico based, but certain card issuers or card programs only allow people of certain nationalities. So if you happen to be born from a village or something and miss the deadline to get an ID, you can never touch a card anymore. But with like some of Visa, MasterCards, or like gift card programs, now people are buying prepaid cards with stablecoins to get the necessary like supplies or software that they need in order to build things and earn a living. So those are like super interesting accessibility angle of how stablecoin enabled cards can help people have a better life.
It's amazing. Ben, I'm curious, same question to you. If you were to think about payments from first principles and thinking about stablecoins as the foundation, how do you think about what we can build, what's possible, and what the opportunities are?
Peter, I have been trying to think about payments from first principles for a long time. And I have had the opportunity to build more of like direct to core banking systems. And I just think that, like, generally, once you see protocols and the amount of bandwidth available to use on protocols and how to inject stablecoins into them is just so hard to unsee. Because if you could take out the restrictions of all of the permissions and all of the gates that stop people from building software on traditional rails, you just eradicate them. Maybe it's not about like the structure of the technology in terms of speed and cost, but maybe it's the structure of the technology that makes it buildable upon. If you're a developer and you have access to the internet, you log in and start building on protocols. If you want to initiate an ACH file, like how many people have ever signed a third-party ACH origination? ACH, or shit, even saying it's a pain in the ass. Like, how many people have gone through and done that? Like, it is not enjoyable, and it stops a lot of people from actually building innovations that can actually be utilized by millions of people. And so I think maybe that's the big innovation. Maybe that's the first principle. Maybe it's more about like distribution through access. I don't know, I'm just riffing. I didn't read my talking points clearly.
I think that was great. And with that being said, I don't want to keep the questions for these speakers to myself. I want to throw it to the crowd, maybe to ask one or two questions before I ask my final follow-up question. So if anyone has a question in the crowd, please raise your hand, throw it to any of these speakers, and we can see if this has sparked any ideas. Anyone have any questions? Or I'll be greedy. I'll keep asking them.
It's hard to get the first one out of the way.
It's always
Don't be
hard to
shy.
get the first one. All right, I'll keep asking them, and if there's more questions at the end, we'll give another opportunity. So the one thing that I wanted to talk about with card payments specifically is what you hear that it's sometimes just a race to the bottom. And I'd love to talk through the economics of card payments, how it compares to traditional payments, and maybe debunk the fact that it's just a race to the bottom and there's no economics in it. And so, Ben, maybe back to you. How do you think about the economics here? And do you think it's a race to the bottom, or do you think that there's a valid business here?
I have thoughts, but I think Farouk is the best one to speak to this. I pass that to you.
Come on, Ben. You got
We're going to end with Farouk, but we'll go to you, Farouk.
Oh, guys, I mean, look, it depends on what people are trying to offer, right? I think if you're trying to offer like a table stakes solution with very little differentiation and you're just competing against like this is on this network versus that network, I mean, I don't know if it's a race to the bottom, but it's the race to mediocrity, right? Like it's just a table stakes solution, not meaningfully better. I mean, if you think about like a closed loop stablecoin based card, it really just is a prepaid card. It's a glorified gift card that is redeemed by the same issuer that mints the token. We think that that's pretty derivative, and it's a way to go backwards. I think what's exciting to us about this space is that stablecoin adoption is increasing. More and more enterprises are interested in exploring stablecoin issuance. I think that closed loop stablecoin issuance is going to have a space in this market, but I think that what's exciting is the opportunity to build interoperability between different stablecoins and letting them cross ecosystems. Like, one of the promises that is still as yet undelivered is the promise of being able to send a payment from Cash App to Zelle or Venmo, right? We still can't do that today, right? And these are massive companies with massive domestic user adoptions, and I mean, we can't do that, right? And so one of the promises of payments here is that how do you create a different system that creates the ability for users to transact freely in the face of this expansion of interest among large enterprises. Now, on the card side, cards are just a mechanism to transact, right? Just like tapping your phone is a mechanism to transact. And I think that whenever the conversation becomes boiled down to, is it faster, is it cheaper, is it better, or whatever, I think what we lose is the opportunity to build something that is better, that people are willing to pay something more for, right? I think the value here, and the reason that I'm excited about the space, is that there's a universe in which people are willing to pay more for something that is tangibly better, or willing to pay the same for something that's meaningfully better than what exists today, right? And what we found is that that opportunity exists. Like every time there's been a meaningful upgrade of a network, right? You look at media distribution, you look at telephones, you look at airplanes, right? Like airplane tickets. Like we've seen the opportunity for new winners, new losers, right? And we've seen the opportunity for user products, like what we are buying as a consumer, to improve. And I think that that's really the promise of stablecoins and the promise of like stablecoin-like payments. I don't think that we should be thinking about this as a derivative way, because it's not about competing with existing incumbents. It's about building something to create the future incumbents. And that's the exciting part. Right? Like, I don't think anybody's here to be like, you know, I really wish I could take $10 billion in market cap from X, Y, or Z company. It's really about what happens when you can expand the pie and capture a net new $100 billion in market cap. I think that's the exciting part.
That's a great answer. I think you touched on like a little bit today, it's, you know, cards we use to like tap and pay. The last panel before us, they started talking about agentic payments. And so I'd be remiss if we didn't talk about what's the evolution of cards, what's the next form factor of payments, and what does that start to look like? Anna, maybe I'll start with you.
Yeah, I have a couple of points to add to that. So I think first, the audience here might find it funny that majority of crypto or general technologists entering into the blockchain space believe that Visa takes all 3% of the transaction fees. And every pitch I hear from like new people building in this space is, we want to disrupt Visa. That's like completely not true for people in fintech.
Don't forget MasterCard.
Oh yeah, sorry, MasterCard and Amex and all that. Two is that I think with the rise of like cards currently, to make a maybe blockchain analogy, it's as if you have your private key out every time you're sending a transaction and the network is saying like, oh, I'm going to detect fraud. That's not how blockchain and stablecoins work. We have public keys and private keys, and the signature, it just reduces fraud in that direction. So I think the way cards are currently structured are not really good for agentic payments or for international payments, and that might get disrupted in the future. That's what stablecoins can do, and traditional card networks are not really set up to do. The other point is that I think with the adoption of, there's a huge rise of stablecoin cards for embedded finance on chain, which is something, it's a recent trend where almost every crypto or blockchain company, including us, we looked at the economics, many others launched, like there's like dozens and dozens of stablecoin backed cards now. I think a lot of that is going to get consolidated, but it also shows that it's much easier to have embedded finance with stablecoins and with cards. I think Rain runs like hundreds of programs now. So that's another trend that I'm seeing. And then lastly, I think the reverse adoption is pretty interesting. We're no longer nowhere near that, but right now most POSs only support cards. But if you look at internationally, like in Asia especially, a lot of these POSs support like dozens of payment methods. I think one day we're going to see stablecoins get reverse network effect, like infiltrate into the Trojan horse into that system, and then one day you'll see that, oh, maybe you don't need card networks. You have a card-like thing that is accepted both as a Visa, MasterCard, Amex, and Diners Club, or you can just use like Solana or some other network directly to pay. So I don't know if cards will be a thing like, say, 50 years from now. I think so, but it may not be the major consumer payment method. So question mark.
Yeah, I have something else to add there. It's pretty interesting from the data we see. We have hundreds of merchants and service a lot of marketplaces, remittances, exchanges, and one of the value props is not pricing, but the speed. And people are willing to pay for speed a lot. And for example, we had a marketplace doing hundreds of millions of dollars a year, and they're charging about $150, 150 basis points, so 1.5% to get your money instantly for their end users. Or ACH or a slower payment method for free, and 85% of their user base is saying yes to that and paying for that. Venmo does the same thing, Coinbase does the same thing, et cetera. And it actually blows people's minds, because I've told like our investors those numbers and potential investors, and they're like, why would anyone ever do that? And it's like, you guys aren't the target audience, but there's a lot of people who really value getting their money instantly. So adding that service of, hey, instead of waiting 2 or 3 days, you can get your money instantly. People are willing to pay a very big premium for that. And some of it's just a peace of mind thing. Like some people even have the ability to, they don't need that money instantly. But if you're a seller in a marketplace and you sold an item, getting that, instant gratification and the dopamine hit of you have that money in your wallet, you hit withdraw, it's in your bank account, that makes it feel way more real. And it also creates this loop of coming back to the marketplace. So we see a lot of the speed, people paying for it. So not necessarily a race to the bottom if you can give these value-added services, whether it's speed, security, whatever it may be.
It is hard to underscore the importance of what Dan just said enough. Because if you think about sort of like the last wave of fintech, we saw an innovation where it's like merchants get paid next day. What Dan is talking about is getting paid 30 seconds after the card off. And so if you think about whether or not there's an agent on the other side of that transaction, do you think the computer wants to get paid faster or slower? Like, it is not a complex thought. The way computers work is they find the fastest route. Like, that is what computers do. And so we have now all of these other services that are consuming payments or consuming stablecoins in different ways that will want to get paid faster. And we make internet-connected devices faster than we make people. And LLMs are going to grow faster than internet-connected devices. And so if you just sort of like watch the trend, what ends up happening is like there's all of this software that is stablecoin internet first, which is not even really connected or won't even think in the old infrastructures. And again, I think we're at the beginning of that, but it feels like we're right there. And if you're running a company that's basically taking in cards and you can pay like publishers or pay whoever is basically providing the data instantly, what would you choose? It's hard not to look at parallels in like the energy market where like that type of like real-time payment or like closed window settlement won't be applied to how LLMs work. And like that was impossible in like ACH FBO land, but now it's possible with protocols. I mean, I think it's going to bring use cases that we haven't really even thought of yet.
Yeah, TradFi is built for humans, and stablecoins are built for agents and robots and humans.
I love that. I think one of the things we haven't touched as much about is like the global nature of stablecoins and how they enable borderless transactions. And a lot of the recent announcements have talked about issuing cards because of that global factor and because it gives them access to so many markets versus the complexities that come with maybe the traditional way of issuing cards. And so, Farouk, probably a great place to start with you again, but how do you think about the global nature of stablecoins and the benefits that come with it?
Look, I mean, going back to what I said earlier, right? Like, vast majority of dollar circulation is outside the United States. And so it's already a global dollar economy. right? We're already working, I mean, people around the world transact in dollars. They have nothing to do with America. And so, you know, the reason we started there's two reasons we started with the card payment enablement on the blockchain. One of them was that card payment transactions are the most complicated type of payment transaction. And so we knew that if we could get the underlying infrastructure built to authorize a transaction, post-pending transactions, refunds, chargebacks, incremental auths, all the stuff that we have enabled using our technology on the blockchain, and we can get it working on the 10 different blockchains we support today on any token we can power, we could do a transaction for, you know, a debit or a credit. Like that's it's easy, right? And so internationally, the big part of this now is like, how do we enable multiple different use cases for people around the world? And we do, right? We provide utility and dollar savings accounts, dollars earning accounts, and dollar spending accounts to people in over 90 markets today, right? That is enormously powerful. We see our payments, I mean, we see people spending stablecoins at hundreds of thousands of merchants globally, right? That's happening today. The merchants don't even know that they're accepting stablecoins. And they're making those transactions in local currency today. So these are not problems anymore. This is actually actively being solved as we're talking right now. There's probably thousands of transactions happening, all powered by us, everywhere in the world, where people are just transacting. And they don't have to worry about, oh, is this a Braille issued stablecoin? Is it a USDC? Is it a Tether? Is it on Tron? Is it on Base? Is it on Solana? All of that has been solved already. And so that's the magic of being able to transact. Like, I think the main thing that we realized was that every time there's been an improvement in the underlying technology or the underlying infrastructure of something, the entry point and the exit point generally stays the same. If you look at airplanes, right, like you go to the same place to get on an airplane and you land at the same place you've always landed. And the technology that gets you there is better. The seat is more comfortable or less comfortable. It's faster or slower, but you're going from the same place to the same place. So we've been really focused on how do we embed technology improvements and stablecoin infrastructure into what is already a transaction the customer is making. And how do we leave the customer experience the exact same, right? And that's been our focus, because we think that we shouldn't require the customer to change their behavior. So they don't have to worry about FX. They do it the same way they always have done it. They mentally calculate the same stuff the same way they've always done it. And if we can drive them savings, we can drive them more utility, faster adoption, faster delivery, easier use, lower fees, that's the value add. Like, customers don't care it's stablecoins. They just care it works.
Go ahead, Anna.
But the actual problem here, so we got user complaints from, and not to throw shade on the stablecoin issuers, but maybe a little bit. Most of those users are in places like Brazil, Nigeria. They always complain. They're like, why am I paying 1%?
Yeah.
They don't know it's you, but like, why am I paying 1% to like, I don't know, Solitaire?
Yeah.
I can't use it. How do I do that? And for issuer or program managers, your issuance location becomes really important, and yet it doesn't seem like you can just say, I'm a global issuer. You have to be like domiciled.
Yeah, and for us, like, we're actually actively expanding local issuance capabilities, right? Like, for us, it's really about optimizing the settlement in local currencies where possible, because we want users to have that benefit, right? But I think one thing that people kind of forget, like, I mean, I was talking to somebody today, they have a massive program in Brazil. Like, banks charge 5%. So 1% fee charged by Visa or MasterCard is actually a massive improvement to what the alternative is. Like, Western Union charges like $15 for a $5 transaction, right? So, like, there's massive differences in kind of, and of course, like, customers are always going to complain. They always want it cheaper. They always want it better. But ultimately, like, if you're building the infrastructure and you're building the utility, eventually you will be able to drive savings and improvements. It's just that you can't take everything, you can't take something from a 30% fee and drop it to a 0% fee or pay them to use it. Where, I mean, I would love to be able to pay users to use it, right? But, I mean, unfortunately, it's just not, like, you know, I mean, if we're not UNICEF, right? We're not running a charity.
Ben, Daniel, anything to add?
I mean, in terms of like where we see a big advantage is like the whole stablecoin globalization. Like, we're a payment service provider. We have local payment rails in a bunch of regions. We're like 2.5-year-old company, so we don't have it everywhere, right? And the benefit of stablecoins, and I think what's cool about the stage is, if I have a global marketplace and I can take in cards globally and some bank transfers globally and some local networks, but maybe I can pay out to like 70 plus countries. I can't pay out to all the countries, but I can bring Rain in, they can issue a card off that. I can bring Braille in, they can give stable coins and load it up into those wallets. Then I can get Anna in the equation as well. If they need to swap to a local stable coin or something like that, they can go through a stable swap. So you can stitch all these things together very quickly, even if you don't have it, which would be near, as Ben said, like you have to go to these VPs, executives, fly to different countries to get all these partnerships. But the proof of like, hey, this person in this other country that's a seller of this item or received a remittance has a stable coin with one click and one transaction on a chain like Solana or something, can send it within seconds, and the other counterparty receives those funds and can do the last mile, they can issue the card off of it. You can stitch together some pretty awesome stuff for being a scrappy startup. And yeah, that just makes you go way further, power more companies, power net new experiences. And that's where I think like this whole global game works, where you can just stitch together partnerships very, very, very quickly.
Ben?
I mean, +1 to everything. It's kind of like, it's amazing how many things can simultaneously be true. And, you know, it's like, Dan has merchants that have so many different products, physical, digital, and once you kind of just experience that path, if you get paid faster and you get access to your money faster, you just don't want to go back to waiting. You know, and as Farouk very eloquently said, people like don't really, a lot of the users of these things don't care they're using a stablecoin. They just care that it's like better, faster. And so it feels like that's just unlocking so many incredible use cases. And again, once you sort of like experience that speed, why would you wait? There's a whole like generation of developers that aren't going to know a different way. I think that's just awesome.
Amazing. So I'm going to throw it to the audience again to see if we have any questions from everyone. We do have some mics that'll be running around, so if anyone has a question for this group of people.
Nice.
Let's start here maybe.
Spun up the curiosity.
Hey guys, thank you very much for this presentation and conversation. So my question is simple. As there are a lot of stable coins on the market right now and appear new and new, so what's the value of having my own stable coin?
What's the value of having your own stablecoin?
Yeah. So why 1+ stablecoin? What's the value?
Yeah.
I'd like to take that.
That's perfect.
Yeah.
I'm like, so, and I apologize. I had a little bit of hard time hearing. It was, what's the value of having your own stable, right? So like, it's like, what's the value of having your own website? You can customize it. You make it yours. You put whatever you want on it. Customizing and programming your own money is not even like a thought because it hasn't been possible before. And I think by just like unlocking it, it will make it very possible. And you know what? Some people do put their content on like, I mean like, was a blogger? Was that like the thing you signed up for to like put it up that you just signed up, Blogger?
How did you know?
But a lot of people actually chose to like customize WordPress. And I think the reason we have so many domains and we have so many brands is because we like to customize things. And I think it is really as simple as that. How you would customize it is up to you. So like, let your creativity be your guide. If you're not a creative person, I'll give you some ideas, but like, it's now possible. And by virtue of it being possible, I just think more people are gonna do it.
I actually moderated a panel last week on this, why everyone will have a stablecoin. I think it's like embedded finance much easier. Instead of like having a team to manage your company or brand's embedded finance, you can have like one dude working there and have a stablecoin. The other thing is stablecoin liquidity used to be, and we are in the stablecoin liquidity business, it used to be a huge pain, but now we're moving closer and closer to the issuance origin. So currently, like for example, we work with Braille and CoinFlow. We have a liquidity pool that's CFUSD CoinFlow's stablecoin. But users need to deposit dollars both sides so that it has liquidity. What I'm looking at in the next few years, or maybe even in the next couple months, is, for example, how to figure out if we could provide liquidity for CFUSD via Braille, because Braille is an issuer. They can essentially infinitely mint CFUSD with an eligible collateral, i.e. like USDC or PyUSD, USDP, or dollars, and we can just tap into their ability to mint because we can never outcompete the amount and depth of liquidity that the issuer has. So with that, the brand or the company that's having their own stablecoin will not need to worry about liquidity slippage and coming in and out of that friction, and therefore they just get net gain. Is like they have brand, they have ability to customize, they can choose how they want to distribute that dollar, and even better, if you have a super strong brand, somebody else might want to use that stablecoin and you earn float on it. So net-net, it's pretty positive for like really influential brands. Like for example, we were at a dinner with some banks and stuff this week, and we're all talking about like how Capital One or MasterCard or like those types of financial institutions, it kind of makes a lot of sense to have their own stablecoin because they have a comprehensive ecosystem, and you can use that stablecoin in that ecosystem, and the effects compound over time. So I hope, if you guys don't have questions here, I'm assuming every one of you is going to build on stablecoins, and if not, please ask us questions.
Anything to add, or should we go to the next question?
We can go to the next question.
Next question. Yeah, here.
Thank you guys, great discussion so far. I wanted to kind of poke or tease out a little bit, Anna, what you were just saying. You know, the name of the forum, how stablecoins are disrupting traditional card payments, right? I heard a lot about not trying to compete with Visa, MasterCard, American Express. So I'd love to just hear from this group, like what would it take to do more of that competition? Is it an internal sort of competition, as Anna was saying, or you know, even if you're not trying to do it today, what would that world look like?
Yeah, look, I think that we're starting to see a lot of people in a variety of industries utilizing stablecoins for counterparty payments, right? We support B2B payments as well, right? We also support individuals to pay other people in stablecoins. And so we are starting to see a lot of cross-pollination where one customer is paying another customer in stablecoins. And we're not encouraged, like we didn't surface it, it's just happening, right? And we even see transactions where our customer is using a stablecoin backed card or powered card, and then they're swiping it at CoinFlow, and then CoinFlow is minting it into stablecoins and sending it to a merchant. Like we already see transactions like that. And so like a lot of people in the stablecoin space over the last like year or so have been talking about this fiat sandwich where it's fiat, stablecoin, fiat. We're actually starting to see stablecoin, fiat, stablecoin, right? So it's a fiat sandwich. And like that's, I mean, one of the things about how you start disrupting any type of existing payment network, right? Or any type of network. We saw this with mobile phones, right? Like most phone calls by mobile phones went to landlines. Most landlines called each other. Eventually, there was a sea change. And it didn't happen because people just were like, oh, you know, mobile phones are meaningfully better. It just happened because consumer choice made it happen, right? And it just became possible, and people slowly realized, hey, I can actually make a call on the go, and you know, my mom can call me without having to upgrade technology, and that's really what it was about. And so we are still in the very early innings, like Ben so wisely said. And what we're starting to see, though, which is encouraging, is that we are starting to see that cross-pollination of payments, where customers are actually choosing to pay each other, and they're starting in stablecoins, they're ending in stablecoins. And that's really the magic of this whole industry, right? Like there's lots of industries now, like if you look at logistics or trade finance, et cetera, there's lots of public cases now where people are transacting in stables because they actually need to be able to hold an asset for X period of time, and then they have to sell it to someone else, and then they have to move it, you know, from one counterparty to another, and they're using stablecoins for that because the settlement happens instantaneously. You actually physically transfer the value. There's no takebacks, and you can actually create that economic value in that transaction because you can do it in a high frequency way that wouldn't be possible with an ACH or a wire or a SWIFT.
Peter, maybe you can talk about Circle's payment.
Sorry?
Didn't you guys launch the payments API or payment network?
Yeah, we launched Circle Payment Network a couple of weeks ago, and I'm but a simple moderator, but it's something that we're very excited about, and we're looking for design partners to join the network on both sides, on participating sides, on receiving sides, and so anyone who's interested in that, happy to talk more about that. But yeah, I think a lot of power comes in networks, and I think we've talked about it a lot with these partners on stage. All of these people are working together. I think we have this stablecoin conference where if you want to do something with stablecoins, there's someone in the stack who can help you do it, and so it's really exciting to be here. I think that's all we have time for today, but I want to thank our speakers for being here. I want to thank all of you for being here. Thank you so much.